Welcome to the Deep Dive. Today, we're really going wide, looking at the big picture where global politics, tech, and finance all collide.
Yeah, we've sifted through a ton of material Fed reports, AI infrastructure analysis, crypto forecasts, even some pretty intense local politics.
The goal is to connect the dots for you.
Exactly. We want to cut through the noise and figure out what's structural, what's really changing the game underneath it all.
So here's the big question we keep coming back to. Is it recession? Are we heading for this big economic downturn everyone seems braced for?
Or are we actually in the early stages of a massive structural boom, maybe masked by some political and infrastructure growing pains?
That's what we need to unpack. Let's start with that recession narrative. It feels like it's everywhere.
It really does. Constant headlines.
But the core data, what does it actually say? Why the disconnect between the fear and maybe the reality?
Well, the classic definition, the one academics use for decades, 2 straight quarters of negative GDP growth. We're just not seeing that right now. The economy, fundamentally, it's still throttling forward. Consumer spending, productivity gains, they're there.
So where's the fear coming from? Is it just uneven?
It's definitely uneven. That's part of it. And I think there's also this institutional reluctance, maybe, to admit that technology is changing how we should even measure the economy. Old metrics might not apply.
Right, because you can't ignore the pain points. Some sectors are hurting, companies are cutting jobs. We see that.
Absolutely. But it looks more like sectoral decline, not systemic collapse. That's the crucial difference.
Explain that. What kind of sectors?
Think about industries or administrative layers that got really bloated, maybe unsustainably, during that zero interest rate period after the pandemic.
Okay.
Sources suggest capital is moving aggressively away from those areas. One source, pretty provocatively, calls it the woke industrial complex contracting. But the underlying point is about non-productive overhead, especially in big legacy companies. It's getting cut because it just can't compete for capital anymore against high-growth, productive ventures.
So it's painful, yes, but maybe a necessary reallocation, a sort of harsh cleanse.
That's the argument, yeah. Capital's flowing out of those areas and into something else.
Okay, so where is it flowing to? What are these structural boom drivers you mentioned?
This isn't just a temporary bump. We're talking genuine paradigm shifts.
Yes.
Artificial intelligence, obviously, advanced robotics, biotech is huge.
Space exploration too, right?
Yeah.
With the reusable rockets changing the economics.
Exactly. And decentralized finance, Bitcoin leading the charge there.
And the scale of growth in these areas.
It's staggering. You look at the big players, the multi-billion, even trillion-dollar companies in these niches, they're reporting growth rates of 20, 30, sometimes 50% year over year.
Wow.
That kind of velocity at that scale, it creates this powerful counterbalance to the pain you see elsewhere.
Which connects to that NBER controversy, doesn't it?
Right.
The National Bureau of Economic Research, the official recession callers.
Right. In 2024, they had 2 quarters of negative GDP, the traditional trigger.
But they didn't call it a recession.
They didn't. They pointed to other factors like employment staying strong. It was fascinating because they basically ignored their own historical yardstick.
So the rulebook got thrown out.
It sort of signals that the old definitions maybe aren't enough anymore in this tech-driven economy, or perhaps they were avoiding the political heat of calling a recession. It's hard to say definitively.
Okay, let's pivot. The Federal Reserve, huge pressure on them. If a deep recession isn't the main threat, what are they really worried about? Especially thinking about their jobs mandate.
The signals suggest their primary focus, though maybe subtle, is shifting towards the labor market impact of generative AI.
Ah, interesting. The boom that kicked off late 2022.
Exactly. Automation is starting to cause a measurable slowdown in certain types of job creation, repetitive white-collar roles, for instance.
So it's not a collapse in demand causing job losses, it's efficiency.
It seems like it. Technology-driven displacement. And that puts a different kind of pressure on their maximum employment mandate. It requires a different policy thought process.
Which leads straight into the politics of interest rates. Fed Chair Powell, the election year. Sources suggest policy isn't happening in a vacuum.
No, definitely not. The consensus from many we looked at is that political scrutiny is intense. One view, quite strongly stated, is that Powell is let's say, allergic to appearing influenced by political figures, particularly someone like Donald Trump advocating for cuts.
So trying to show independence might lead to hesitation, a kind of gridlock.
That's the argument. That political resistance, this need to seem independent, might be making the Fed more cautious on rate cuts than the pure economics might suggest.
And Treasury Secretary Scott Besson is publicly pushing back on that caution.
Hard, he's been very vocal.
Saying the Fed funds rate should be, 150 to 175 basis points lower? So down near 2.6% to 3.0%? That's a big cut from where we are.
It's a huge cut. Besson's core argument is that Powell is fighting the last war, obsessed with avoiding a 70s inflation rerun.
Right.
And Besson thinks that's blinding the Fed to the deflationary forces of technology happening right now.
So Besson's target rate, 2.6 to 3.0, is that significant?
Very. It aligns with many estimates of the so-called neutral rate, R-star, the theoretical rate that's neither boosting nor slowing the economy.
So he's saying, get back to neutral, fast, rip off the Band-Aid.
Essentially, yes. He argues current rates are far too restrictive, choking off the innovation boom unnecessarily.
If he's right, what's the real-world cost of keeping rates too high, too long, beyond just stock prices?
Oh, it hits everyday life. 3 big areas. First, affordable housing. High capital costs just paralyze construction, make mortgages impossible for many.
Okay.
Second, business investment, especially R&D, the innovation engine. Cheaper capital fuels that AI, robotics, biotech progress we talked about.
Makes sense.
And third, retirement security. Lower rates help stabilize asset values. That's critical for pension funds, for individual retirement accounts, helping them get fully funded. It secures the future for millions.
Okay, let's connect that to a potential beneficiary. Digital assets. Tom Lee's out with some very bullish calls.
Yeah.
Bitcoin, $150K to $200.
Yeah.
Ethereum, $7K to $15 by end of 2025.
Yeah, very aggressive targets. But his logic is pretty straightforward.
Which is?
Fixed supply meets overwhelming institutional demand. Simple as that, almost. He sees institutions just consistently buying, using any weakness to add more. They're not speculating. They're structural, long-term buyers.
And Ethereum's strength plays into that too.
Definitely. The underlying network utility is undeniable now. Stablecoin volume, application revenue, hitting all-time highs. It's proving itself as financial plumbing, not just hype.
Jordi Visser had that great analogy, calling this Bitcoin's IPO era. What does that actually capture?
It's a really smart way to frame what's happening with ownership distribution. Think about a traditional IPO.
Yeah.
Early investors sell shares to the public, right?
Right.
Here you have two sides. Old holders, people who got in maybe 4 or 5 or more years ago. They're willing to sell some holdings now that prices are significantly higher, maybe above $105,000, let's say.
Okay, the early believers taking profits.
Some profits, yeah. And on the other side, you have the new institutions. Massive capital pools, RIAs managing billions, family offices, maybe even sovereign funds down the line.
And they're coming in now.
Regulatory clarity, things like the ETFs give them the green light, the structure they needed to participate with serious size.
So that sideways price action we've seen, maybe balancing between, say, 105K and 125K, that is the IPO process happening, the clearing mechanism.
Exactly. That's not stagnation. It's incredibly active price discovery. It's where the supply from those long-term holders is being met and absorbed by this huge wall of new institutional demand.
And once that supply is absorbed?
Well, if the institutional buying pressure remains constant and the available supply at that price level dries up, you run into illiquidity. That's the setup for the kind of massive breakout Lee and others are forecasting.
Fascinating. Okay, let's shift to the engine itself, AI. Satya Nadella at Microsoft dropped a bit of a bombshell, didn't he? So the bottleneck isn't NVIDIA chips anymore.
Yeah, that was surprising. He basically said chips are sitting on shelves now. The silicon constraint has eased, at least for the moment.
So what's the new bottleneck, if it's not chips?
It's shifted, and it's much harder, potentially. It's power and space. Specifically, space for these massive, specialized data centers AI needs.
Power and space. Why is that harder than making chips?
Because it involves real-world, large-scale energy infrastructure. We're talking substations, high-voltage transmission lines, the kind of stuff needed to deliver gigawatts of power reliably. 2047.
Gigawatts, like city-level power.
Pretty much, yeah, for these huge AI training clusters. And building that kind of electrical infrastructure, that's the real time sink.
How long does that take?
Years. Yeah. Getting permits, securing land, the actual construction. You could easily be looking at 3 to 5 years just for the power infrastructure before the data center can even come online.
3 to 5 years. In the AI race, that's an eternity.
Exactly. It completely stalls the rapid deployment everyone wants.
Which brings us to an unexpected player. Bitcoin miners. Entering the AI co-location business. How does that work?
It sounds strange at first, but it makes perfect sense. Companies like Riot, Cipher, Core Scientific, their whole business was managing massive, fluctuating energy loads for mining.
Okay.
So they got incredibly good at two things critical for AI data centers. First, negotiating huge, complex power purchase agreements, PPAs, directly with power generators. They know how to secure megawatts, even gigawatts of power.
Right.
Second, they mastered rapid modular deployment, building out compute capacity in shipping containers or prefab units very, very quickly. They solved the warm shell construction problem that plagues traditional data centers.
So they can stand up compute power in months, not years.
That's the edge. They already have the land, the power agreements, and the deployment expertise. They can offer AI companies capacity much faster than building from scratch.
So in a way, the sheer energy hunger of AI is forcing us to get smarter about energy infrastructure overall.
Absolutely. It's inadvertently driving investment. To meet that huge, constant 247 AI demand, you need firm power. That's pushing faster development of things like advanced nuclear and finding ways to make renewables more reliable with storage or backup.
It's like a computation-driven industrial revolution forcing an energy evolution.
That's a good way to put it. The infrastructure is racing to catch up globally.
Okay, final topic. Let's bring this all down to the street level. The New York City mayor's race. We see candidates like Mamdani, Cuomo, Sliwa. What does this intense local battle tell us? It seems driven by anxiety over costs, inequality.
Yeah, it really reflects that broader tension. You look at the frontrunner, the Democratic Socialist Asar Mamdani, and policies like, say, free city buses or massively expanded free childcare.
Things aimed at easing the pressure on people.
Right. But the immediate critique is solvency. Can the city actually afford it? New York is already facing serious financial strain, heavy debt.
So the argument is you can't just remove revenue streams like bus fares and massively increase spending without a plan for where the money comes from.
That's the core economic critique, yes. That these policies, while addressing real pain, are maybe politically appealing but economically unsustainable band-aids.
So if free things isn't the answer, according to these critics, what are the viable, long-term solutions for affordability and opportunity in a place like NYC?
The solutions proposed in the sources tend to be, well, politically tougher. They focus on the supply side. First, massive housing deregulation.
Zoning reform.
Exactly. Eliminate restrictive zoning to actually allow much more building, increase supply dramatically. That's seen as the only real long-term fix for high rents.
Okay, what else?
Tax structure reform. Lowering corporate and income taxes, the argument goes, is needed to keep wealth creators and businesses from leaving, to broaden the tax base through volume, not just high rates.
But the counter-argument is always, deregulation builds luxury condos, and tax cuts just help the rich, right? How does that help the people feeling the anxiety most?
And that's the central paradox, isn't it? Proponents say more supply anywhere eases pressure everywhere. Opponents say direct intervention is needed now.
It seems to come back to fundamentals.
It really does. And interestingly, some voter data highlighted in our sources was surprising. Support for socialist platforms often came from wealthier, more educated demographics, viewing it almost like charity.
Really?
Whereas many lower-income voters apparently saw these policies as, well, temporary fixes. They understood it didn't address the underlying lack of opportunity, things like financial education, the ability to build assets.
So this whole NYC race, it's a symptom.
It looks like a symptom of a breakdown in financial literacy, maybe.
Mm-hmm.
When people feel completely shut out from the structural boom, the AI, the crypto, the biotech wealth creation, they understandably reach for political solutions that offer immediate, tangible relief.
The political opiates, as one source put it.
Right. Instead of finding paths to become asset owners themselves to participate in the upside, it's this choice between perhaps facing economic reality or chasing political promises.
Okay, so pulling it all together. A structural boom clashing with recession fears. Political gridlock at the Fed acting as a brake. AI needing power infrastructure that isn't there yet. And local politics grappling with symptoms, not maybe the root causes of financial exclusion.
That sums it up pretty well. The pieces are all interconnected.
What's the final thought for our listeners to chew on?
I think it's this. In this incredibly fast-changing economy, maybe the best defense against feeling powerless isn't purely political action. It might be a fundamental shift in your own approach.
How so?
Moving your mindset and your actions from being solely a salaried worker trying to keep up with inflation towards becoming an asset owner who can actually participate in this structural boom.
But that takes...
It takes financial discipline, it takes education, it takes choosing to understand the economic reality, even when political narratives offer easier but maybe less effective answers. It's about opting into the upside.
Choosing economic reality over political fantasy. A powerful distinction. Thank you for walking us through all that.
My pleasure.
And thank you for joining us for this deep dive. We'll see you next time.